Hey, good morning, everyone. Marty Missouri here, the 9th of November 2024, with your weekly video update. Folks, today I'm going to rush through this given my calendar this weekend. Got a lot to get to, got to catch up on some of the weekly macro work. And so while there is much to talk about, I may have to add a commentary a week here over the next few weeks just to get to everything I'd like to. But what I'd like not to do is, have half-hour videos that are just too much to, to suffer through, if you will. So thinking about what's pertinent today, I am just absolutely going to rush through a few of the inputs to our index, which stayed the same at a -9 week over week, which means odds slightly favor recession in the coming months. But as we've noted, the recession calls of the last couple of years have continued to be not accurate, and there's lots of reasons for that. The soft data hasn't necessarily coincided with the hard data, meaning sentiment has suggested a somewhat dire setup, while actual results have been better than expected. We know there's quite the separation between the bottom 40% of income earners and the top 60%, one seemingly quite desperate, as you might imagine, with the inflation, yada yada. The other seemingly pretty robust and still willing to spend, although the latter, I think, has a lot to do with what are called pandemic savings that have remained in the system far longer than us or virtually all economists had anticipated. But looks like we're reaching the end of that as well. And of course, as you know, we have a new administration, lots of implications with that, so we'll touch on that as well. So first, just quickly, I'm going to run through some of the inputs that are fresh this week or this last week to our index. And while the score stayed the same, we had one go from negative to positive and one go from positive to negative. Consumer debt or consumer credit data came out this last week. And as you can see, consumers borrowed less this last month than they had the prior month. One might argue that that's a positive in terms of consumer balance sheets and so forth. Economists would agree or disagree with that based on the timing. As you can see, going into past recessions, individuals do tend to borrow less, right, as they go, which makes sense as their spending wanes. They put less money on credit cards and so on and so forth. Typically, people borrow more when they're optimistic. You hope to goodness they don't borrow more because they have to just to take care of their basics. And there's some of that going on, it appears, again, in that lower income earning cohort, if you will. So, I don't know that there's a strong signal there one way or the other, but worth noting because of the sizable drop in terms of the amount that the consumers have been spending on credit cards and other loans. Mortgage purchase applications, as you can see, they have been kind of stuck in a rut right in here, down a bit with the Fed's 50 basis point rate cut. Counterintuitively to a lot of people, mortgage rates shot straight up because that was viewed as stimulative to the economy. The election, Trump's election win, and looks like potentially a red sweep. Right now, we still don't know about the House. Those policies, at least at first blush, appear to be stimulative and many of them very inflationary, so rates have just continued to move higher over the last week or so. One would argue some of those policies would be contractionary, and that would be the protectionist, tariff policies. And I'm going to quickly run through what I did earlier in the week on the last Trump administration and maybe make some further observations around that as well. The Fed lowered interest rates 0.25% this last week. That was 100% baked into futures, as is another quarter-point rate cut in December and about 4 more rate cuts, so another full percent in 2025. And of course, that very much remains to be seen. And one thing that my chart shows you here is that notice that when the Fed had been cutting rates in the past aggressively, here's an exception right here in the 80s, but for the most part, it had to do with either during recessions or leading right up to recessions. And so here we are today, coming down, and you know how that plays out. Typically, the Fed hikes interest rates to a point where the economy gets constrained enough. The hikes come with a lag, as do the cuts. Then the deleterious effects on the economy ultimately, can and typically result in the recession that we have yet to experience. This is a chart of just the stock market, and we've talked about that. The big risk is recessions. These may not look that scary. That was 50%. That was 60% respectively. That was almost 40%. So at these valuations, which I've talked about, macro conditions are going to be very key, particularly from a long-term investment perspective going forward. Consumer confidence is coming back nicely. The University of Michigan survey was out this week. The headline score was nice. Wasn't perfect. People are still struggling with inflation. Current conditions right now, the sentiment there is not good, but there seems to be some optimism, going forward. Of course, you look at the level, and it's not a high level of confidence at this point. And by the way, below 80 during an election, incumbents, I don't believe, have ever won, with the University of Michigan Sentiment Index below 80. So this indicator worked once again. But as you can see, it's kind of moving in the right direction. One thing that I keep pointing out is this very interesting phenomenon is that prior to recessions, it's not unusual in a lot of the data that we track to get this kind of spike, just before. That's not a huge one there, but kind of like a blow off top in the data. So while we need to take the data for what it is and read it, for what it's telling us, we do have to be cognizant of the fact that it's not unusual to get these upward spikes, these positive moves prior to recession, which is interesting. So that's why we need to do a deeper dive into the data and look at more than what's just on the surface. Speaking of that, the services ISM PMI was out this last week. And again, while the internals, we don't have time to really go through them much, were mixed, the headline score was impressive at a plus 56. Now, again, look at the pop right before that recession. This, trend was definitely lower. It did get a nice little pop right before the great financial crisis. Pretty good pop right in here, right before the tech bubble burst and so on. So again, this is obviously, you don't take this as something that's recessionary. You take it for what it is, which is a vast improvement. Another thing too, though, to keep in mind is that typically manufacturing, which is the white line, PMIs do lead the way. You can see here, right, the white line declining before services followed, but we were still in an expansionary area here. You can see the white line rolled over before services rolled over, right in here, while services were still trying to fight their way up. You can see manufacturing took a hit as well. Heavy truck sales rolled over big time this last month. This is kind of an off-the-grid one. You don't hear people talk about this much, but our observation is that it is an indicator worthy of our respect. You can see the big drop that we just had. You can see the big drops before that recession. You can see the big drops before that recession and before this one back here. Here where we had a tough time in 2014, 2016, our recession light didn't quite get lit, but it got close. It was in the low single digits to the positive, and then the economy recovered right in here. And that kind of speaks to that narrative I gave you, at least back in here in the top, when the Fed began to start stimulating the economy. The market was going up, by the way, as I showed you, while things like heavy truck sales were falling off a cliff as they are now. So something to pay attention to, no doubt. The economic surprise index in the U.S. is just getting better, right? So nice move there, as you can see above zero. That says that the economic data is coming out better than what economists had previously anticipated. It's encouraging when we look at the rest of the world. You can see the same lately for Europe. Doesn't mean we're in a great expansion. Just means the data is better or are better than what economists had previously suggested they would be. CPI swap rates, which reflect inflation pressures, you can see how they have popped big time, post the election. So, man, we need to think about that. in terms of sentiment going forward, what that does to rates and what higher rates do to things like equity prices. Container rates, this is the WCI container index. You can see that we like this. This is, perhaps disinflationary, still historically high when you look at these levels, right? But coming off of the very high levels that we had around COVID. But we did see it going in the wrong direction. The Shanghai to LA, I didn't keep that chart up, but that was relatively flat. The Baltic Dry Index was showing increased shipping costs as well. So think about that in the context of future inflation. The dollar, we think we put huge importance on the movement of the US dollar index relative to things like equities and commodities and so on. So this is some work I did here this last week, and I wanted to provide some illustration for the narrative that I've been expressing in client review meetings. And here we are going back to 2022, and I wanted to show that on a short-term basis, this negative correlation for much of the time to the dollar. So you can see in 2022, where on a closing basis, we had a pretty good drop in equities. This shows 25%, a little more than that on an intraday basis. But you can see this whole time that the equity market was suffering mightily, the dollar was rallying mightily, right? So here we had a period where stocks rose coming out of that by 26%, and that trend was weaker for the dollar. Here we had the dollar rising, and here we had stocks falling 10% in 2023. Here we had the dollar tanking, and we had stocks rising 16% in late 2023. Here's an anomaly for this, and that shows on net for that period the dollar rising and the stock market rising slightly, 4% during that 3-4 month period. So, but if you were to do this on a more micro level, we would see that, like right in here, as the dollar ramped up, that's when stocks began to roll over. And short term, we had these negative correlations. But for the period, I have to acknowledge that stocks went up while the dollar went up. Then the dollar had quite the contraction right here throughout much of this year, and we had a nice rally in the S&P during that time period. The anomaly right now is that we had this massive run up here in the dollar, and here stocks are up slightly as well. So we'll see if stocks can hold up right here against the headwind of a potentially higher dollar. There's quite the consensus that the Trump win will mean a higher dollar for a lot of reasons. So we essentially have a pretty classic looking bull flag pattern here. I put two on there. One is right off of this bottom, which would have the dollar getting back to levels we haven't seen since 2022. And if we start our flag right here with this little different angle on the upside, takes us right back up here to this resistance at about 105, 106. And that is an area that has been somewhat problematic for stocks every time we've gotten there. So we'll see how that plays out going forward. Again, just all the various things we're looking at. And by the way, I'm just scratching the surface. Just quickly, the S&P 500 technicals. Like I said, we can end up getting into marginal new highs. It's not going to fix these divergences. Those of you who have been with me for years know how these tend to play out. We're at a very high level here. Market's kind of out over its skis. Looks good. Nobody's complaining. We're certainly not complaining. But when we look at the technicals, it doesn't give us a sell signal, but it says this market looks very heavy right here. Gold, remember we started flagging gold right up in here as getting out over its skis. We had our divergences that were concerning. We own a not small position in gold in our core portfolio. I told you right in here we were comfortable there. Fortunately, literally on this day, we put on a hedge on our gold position, and the next day, we were lucky. The next day it dropped, I think, over 3%, so we didn't take, the lion's share of that hit, and we're still in that. And so the hedge gave back a little bit of its value. We made money that day, though, on net, and then gold was down. So we'll see. If gold breaks down before these levels, we think there's quite a bit of downside potentially for gold right here. Long term, we think there's almost nothing but upside. But it's a volatile commodity, so we wanted to hedge a little bit. We were able to do it very cheaply, at least for the next couple of months or so. Okay, so the analysis I did for you midweek last week on the Trump policy. Remember when we had clearly bullish policies, we had a very strong market during that period, right? Remember I pointed this out. I won't spend a lot of time since I've already done it. Then I said when the trade war rhetoric and then trade war reality gripped the markets, it went nowhere over a 20-month period, except for down mostly during that time period. And when our recession light got lit, we said that the Fed's probably going to cut rates, probably going to be bullish for the market. That's exactly what happened. The recession we were looking for came, but it came with an excuse, and that excuse gave a green light for the most phenomenal stimulus you can ever possibly imagine. In fact, a lot of rule breaking there in terms of what the Fed was allowed themselves to do. Okay, so what you could really attribute to positive Trump policies was that really nice ramp, right, from here to here. But then you could still say, well, this all, not denying this all happened under the Trump administration. Our job is just to identify, what were the predominant stimuli that made these things happen, right? Because all that record stimulus took us to here. It also took inflation to here, and then we had that painful bear market in 2022. Of course, inflation comes off the boil in that regard. The Fed can get accommodative, and then you have this going on. The reality of the situation here simply is that in 2016, you had CPI at 2%, right? You had a Fed funds rate at 0.5%. You had a 10-year yield at 1.8, and you had stocks trading at about 20 times earnings. Today, you have CPI at 3.3%, Fed funds rate at 4.75%, a 10-year yield at 4.31, and stocks trading at 27 times earnings. Man, oh man, that's a different setup given these metrics than what we had back here in 2016, and we need to be very cognizant of that. As I said the other day, this was a market that could absorb stimulative policies without seeing a big ramp in inflation. This likely is not a setup that can sustain the same sort of thing without a ramp up in inflation, and that's going to do a number on consumer sentiment. It's going to do a number on assets and probably do a number on stocks as well, or be a headwind for stocks. But these policies, which are the same things that the administration is talking about now, those are tailwinds for stocks. Now, in terms of just timing, I wanted to just kind of pull back a little bit here. And I was thinking about this morning when I was thinking about what I was going to talk about, and I was reminded of the 2014 to 2016 spot where really stocks did nothing. And as conditions began to wane in here, we did get some pretty notable corrective action. We had a 16% correction from here to here and so on. So the market was just kind of nauseatingly flat. I remember that well during that time period. And so this all came within the context of 2 years of mostly down time, right? So think about that, because going into today, clearly that's not the what we've seen the last 2 years, right? So while there is reason to be optimistic, certainly on a sector-by-sector basis, and as of yesterday, we incrementally added some exposure to an area that we thought presents some value, and we'll do more of that as we go. We do need to be very much on our toes. We have rolled our hedges even closer to the money, so we've got even a little more protection going forward. But as I've been saying the last few weeks, would not surprise me to see this rally continue into year end. It's after we get into the first of next year and we find out really where are we going to start, right? Are we going to start aggressively here? Are we going to start aggressively here? Is it going to be a combination of the two? And then we have to think about what market responses are going to be, and pick our spots, where we need to protect and where we need to take advantage, all within the context of a long-term, non-reactionary, fundamentally based, sound macro approach to investing. That's how we do it. And ironically, I think 2 days after I did my little analysis, Cameron Kreis, who is just a fantastic macro analyst with Bloomberg, did a similar thing, and he just kind of pointed to valuations today versus 2016, and there's something called the S&P Hopes and Dreams ratio. And essentially, I think the best way to articulate it is it basically reflects what the market is discounting that you really cannot fundamentally support. It's that portion of the index not comprised of book value or the net present value of the next 3 years' earnings expectations, yada, yada. So the hopes and dreams index back here in 2016 for the S&P was at 44%, for the NASDAQ at 59%, and for the Russell 2000 at 33%. The change through the end of 2016, so we had a real nice rally, 4% in the S&P, 1% in the NASDAQ, 9% in the Russell, right? And that's the area we're very interested in right here. And then through the end of 2017, we had 10% rally in the S&P, and you can see in the NASDAQ 7, 11% in the Russell 2000, okay? But look at the current hopes and dreams index, 68, 76, 47. Haven't seen it this high since the beginning of the year 2000, and we had quite the bear market for the next 3 years. So again, nothing determinate there, just things that we need to pay attention to. Tech was 59, it's 83 now, right? Healthcare was 49, it's 65 now, right? Consumer discretionary 62, call it 80. Financials minus 13, 42, right? 38, 65 for communications. You get the picture. Real estate about the same. Okay. Energy, interesting. Energy is interesting to us right here as well. Energy is actually more opportunistic based on this index. That's probably the only one I would suspect. Materials are close. I mentioned that we've got a very close eye on materials. We may be adding some exposure here soon to that as well. And it's interesting that the things that we think may be opportune are the things that look relatively opportune for the most part. And it's not tech, by the way, here on this hopes and dreams ratio, if you will. And I think that's probably enough there. Yeah, good article. So much more we can talk about. So, folks, I am just going to do a hard stop right there. Hope that was helpful. Overall, the macro picture still demands that we have some caution allocated to our portfolio going forward. A lot of it depends on where we start with the new administration. We believe that this market at these levels really can't withstand much inflationary pressure, right? That's what basically caused the bear market in 2022. And I think if you push too hard on that, that actually could bring the recession that we've been concerned about. If they focus on tax cuts and deregulation and these things that they're promising, that's a tailwind for stocks. Those would come much, much better if we were in recession and the market had given some back and valuations were much lower. So let's just say that right now we're looking at a heavy market that's at all-time highs and phenomenal amount of noise in these markets. You can see it on a day-to-day basis with correlations going in all directions and dispersion and so forth. So right now, just step back, take it all in, stay smart, be very well diversified, very well balanced, and we think continue to hedge right here and let the dust settle over the coming weeks and months. But along the way, as I said, there are some incremental adjustments that we are actively doing to improve our odds of doing well in an up market, but we are absolutely not ready to abandon the things we're doing that hope to ensure that we do well in a not so good market as well. Folks, thank you as always for watching and listening. Hope you're having a great weekend, and I'll talk to you next week. Bye-bye.